Um, Hello, everyone. Thank you for joining our Making Your Money Go Further webinar. My name is Louis. I'll be hosting and introducing our panel of experts for you today. Just a quick intro on myself. My name is Louis Amarim. I'm the Senior Sales Director over at Driven, part of the Purpose family, where we help SMBs gain capital for their businesses and help them with their operations and their goals. So that's a little bit about myself. I just also want to make sure a quick reminder that we cover over a disclaimer sent over from our legal team. There is no tips or tricks that'll be shared with anybody on this webinar. So if you're looking for any secret stock tips, I don't think we'll find them over here. So before we get started, I just want to let everybody know that we're going to try I'd like to try at least to keep this as interactive as possible. So if you do have any questions while one of the panelists are speaking, feel free to write them down in the chat box. We'll try to answer them, all the questions as they come in. I'm assuming once after the person is finished speaking their part. So I'd like to start off by introducing Craig. Craig is the Chief Marketing Strategist at Purpose Investments with over 25 years of investment experience. Craig combines an educational foundation in economics and psychology with years of experience in both fundamental and quantitative research. Craig's a longtime student of the markets. Thoughts and insights can be seen in his Market Ethos publications and through his regular contributions on BNN. So, Craig, I'll pass it on to you.
Perfect. Thanks. And thanks everybody for joining us. Obviously, I manage money here at Purpose Investments, and my team and we manage about 1.5 billion or so of the 17 and a bit billion that Purpose manages in funds and ETFs and all sorts of other good stuff. But we're not really going to talk about that in particular. Instead, what we're going to talk a little bit about today is, just what's going on in these markets, what's going on a bit on the inflation side, and more importantly, like how we think things are sort of changing as we go forward. So, I think everybody hopefully everybody kind of knows or understands, we all know the economy works in cycles and the market works in cycles as well. They don't actually line up perfectly, but there are some similarities to them. And, I think it's important to point out, we've just come off like a really long, let's just call it kind of almost a magical bull market over the last sort of 12, 13 years until what's, probably started at the beginning of 2022, which is some sort of corrective or bear market kind of environment. And I think it's important to note that a lot of the things that have gone on during that sort of period where returns were actually pretty healthy and almost easy to come by, dare we say, but a lot of sort of excesses got built up in different places. And I think how things move forward and what kind of environment we have going forward is probably going to be somewhat different than the last cycle that we sort of enjoyed from an investment perspective. And so I'm just going to sort of talk about some of those differences and why we think it's going to be different this time, and perhaps provide some insight that you may find useful either in your business or in your investments. But let's jump into it. So, a lot of people have talked about, and again, like obviously the market's down this month, but a lot of people have talked about, how well the market's done this year. It's certainly bounced back for the most part. It's clearly giving back those gains of late. But, go back a month and a half, and, the markets were actually looking pretty healthy for 2023. And I think it's important to note, and, a lot of thought was like, was this the start of a new cycle? Was it the start of a new bull market cycle that could go on many, many years, in which case, you just buy it and set it and off you go. However, one of the things that we've sort of wrestled with is we don't think it is. We think we're in an extended bear market environment, even though we've just had a huge upswing in the first, call it, 6-7 months of this year. And, we think a lot of why we don't think a new cycle has begun is the fact that, of the biggest losers in 2022, so last year, call it like crypto, technology, global equities, US equities, Canadian equities. In fact, in that order, like from, let's call it for 2022, worst to best, are actually the exact same list that are the biggest gainers this year. So we think this is sort of an environment where things are sort of bouncing off oversold levels that we experienced in 2022. And don't get me wrong, it's been a hell of a bounce. But we do think this is sort of just an environment that is probably setting up for an extended sort of period of volatility in the markets. Now, we study cycles here quite a bit from an asset allocation perspective, from a market cycle perspective. And so what I'm saying is, we study cycles to, understand where we should be more exposed or less exposed as we go through these kind of environments. And it's important to note, like from one cycle to the next, the environment really changes and the leaders really change. And, that's important because, I think it's safe to say that the leaders from the last cycle are probably not going to be the leaders in the next cycle. And we've sort of highlighted that in this chart on the top right here that highlights, sectors that win in one year certainly are not sectors that win in the next. And I think that's an important lesson because we all sort of suffer from this environment where we think that, hey, if Microsoft did well for the last 13 years, it's going to do well in the next 10. And the markets rarely work that way. Not saying anything disparaging about Microsoft. We actually own some, but the market very rarely has repeat leaders from one cycle to the next. And it's also worth pointing out, the last bull cycle, that one that looked so good for so long, it's going to be very different than the next bull cycle because a lot of things have changed. The last bull cycle, we had disinflation. Like inflation was actually hard to come by. I don't know, if you listen to economists talk and that type of thing. It's a bit of a hobby of mine, being an economist, but, it wasn't that long ago when people were talking about like the lack of inflation was the problem. There was just no inflation to be found, and that was a problem. And clearly that environment has changed today. If you go back a few years, we were talking about yields were too low. Now yields are, well, let's say normal. They could be getting high, depending on your perspective and how long you look back. But we've gone from another of different kind of changes. We've gone from like a world where globalization was a rising, growing trend for many, many years to an environment that I'm not saying deglobalization, don't quite buy that, but certainly slowing globalization. We've gone from peace to less peace. Like all these kind of big things have changed from the last cycle to probably the next cycle that we're starting to go into at some point. And I think that has implications from an investment perspective. So, where do we come up with sort of some of our thoughts and some of the things that have changed? And, there are some pretty big ones. And if you look at the last bull cycle, it was very different. It had some huge macro trends. We had a consumer that was delevering for much of the last cycle, especially the US consumer. A little bit less on the Eurozone consumer and much less on the Canadian consumer. We didn't really delever at all. Fortunately, that might become a problem going forward, but we won't touch on lending too much here. Nonetheless, we've got this environment where the consumers delevered and the banks have delevered. And, that really put this disinflationary pressure on the last economic cycle and the last bull market. And that's clearly gone now because these dynamics have changed. And we're now in an environment that's gone from sort of disinflation to probably more inflationary. But the last cycle was also really low growth, right? It might not seem like it because the markets did so well, but it was a really low growth decade. And while inflation is probably going to be higher for longer, it's probably coming down near term, but it's probably not going to get back to where it used to be. Yields are probably not going to get back to where they used to be. One good aspect, though, is actually economic growth is probably going to be healthier and more balanced than it was in the last cycle, because the last cycle had this sort of disinflationary, low growth environment that seems to be being alleviated now in one fashion or another. So it's not all bad news for now to the next cycle, but certainly a bit more challenging. And obviously, inflation is possibly the biggest one. It's the one that obviously gets the most media attention. And yeah, we're in a higher inflationary environment now. And, this is going to come down. A lot of this was caused by, goods and supply chain shortages and changes behaviors, because all of a sudden we went from going out to dinner to renovating our homes, and that just screws up all supply chains, even if there wasn't COVID. Nonetheless, we've gone from this environment that was like very low on the inflation side to an environment that probably high on the inflation side right now, and then going to come back down to normal. And because a lot of those disinflationary forces, the credit changes, the deleveraging of the consumer, that was all disinflationary. Globalization, technology, all disinflationary. Demographics, very disinflationary. A lot of these things are starting to soften. So demographics aren't as disinflationary anymore just because of the changing dynamics. Energy's become a bit more inflationary. Globalization is less disinflationary. Technology, I mean, that's a bit of a wild card. It depends how far AI goes, because that could be disinflationary. But again, I think we're moving into an environment that has more normal inflation as opposed to that low, sub 2% kind of inflation that we've seen for the last extended period of time. So we think the next bull is going to be different. The next bull cycle is going to be different. We think yields are probably going to be higher. The cost of capital, the cost of credit is probably going to be higher than what we've been experiencing in years past. And that's, good news and bad news. As an economist, I think the artificially low cost of capital for an extended period of time in the last number of years probably caused a large misallocation of capital. Nonetheless, higher cost of capital isn't a good thing, because that means money is going elsewhere that could be going to different things. And higher cost of capital is certainly a bit of a pain. So, I think this is kind of the environment that we're going into, one that has, somewhat higher yields than we've had in the last cycle and more volatile. And we think economic growth is going to be that way. And we think inflation is going to be that way as well. So it's going to be a much more volatile kind of environment in our minds. And, this has implications for portfolios. I'm not sure how, if we want to get too ingrained in this, because again, this is sort of high level, but it does have portfolio implications to consider. I mean, yields are high again. Like all of a sudden, for years, people wouldn't buy bonds just because they yielded so little. And now all of a sudden they have this healthy high yield. Of course, they've been going down in price to get to that point. Very painful process. But there is sort of this, silver lining at the end of the cloud. I think I murdered that analogy quite nicely. But there's other aspects too that have changed, like, value over growth, the dividend factor, international equities. Like these are all sort of different implications that we think some of these changing dynamics on inflation, global growth, and that aspects will probably have on portfolios. And from our perspective, we think people should be sort of considering, because if you look at what really worked well in the last cycle, it is probably not going to work as well in the next cycle, and it could very well be other aspects that work much better going forward. So a few of the ones that we highlight, I mean, we firmly believe this markets are going from an environment that had like this suppressed volatility. If you can notice how narrow those bars are moving along the past bull cycle from 2010 up to 2019. Now we've moved into this market with bigger swings, both up and down. And yeah, I mean, there's COVID in there. We're going to assume that's not going to happen for another, was it 100 years? Spanish flu was the last one. But anyway, so, we don't think it's going to be something like that, but we do think the market volatility is going to be greater. And we think that sort of lends itself to being a bit more tactical within people's asset allocation. Simplified yield, like this is a fantastic chart. Like we borrowed it from BlackRock. But nonetheless, this is how much of the bond universe, whether it's high yield, government bonds, mortgage-backed securities, a whole gambit of, bonds in the bond universe globally, it's how much of that universe is trading over 4%. And as you can see, in the 2000s up to 2008, 2007, a big chunk of the bond market yielded more than 4%. And then we had this dearth of yield, this long period where almost nothing. You had to go to like emerging markets and high yield which is high yield, of course, is what they used to call junk bonds. And I mean, great marketing spin to call them high yield instead of junk, but clearly risky stuff. Anyway, that was the only place you could actually get a yield of over 4% for so many years. And that causes capital to move in different ways. Like it moved into dividend stocks, it moved into other aspects in search of yield. It moved into complex yield solutions to try and sort of manufacture yield for investors, because again, people still needed the cash flow. And, that caused money to go into kind of exotic strategies or far off locations to try and find yield. But the encouraging thing is now, like the universe is actually almost all yielding over 4% again, like cash is over 4%. So all of a sudden you're in this environment where, you don't have to be fancy, you don't have to be complex to get yield again, and you can actually simplify where you're getting your yield. Not saying some of those other strategies aren't good, it's just you can start to simplify and use almost plain vanilla sources once again. We think real assets. Listen, we are firm believers. Inflation is coming down now. It'll probably get a bit of an uptick in the near term as some of the older base rates normalize, and because of the higher energy prices and the lagged effect on rents. So inflation will probably tick up a little bit in the next few months, but the broader trend, if you look 6 to 12 months out, is lower. It's probably not going to get back down to where it used to be, but the trend is lower. Now, that's certainly good news, but as I mentioned, like, there's a whole bunch of aspects, like whether it's globalization, demographics, other factors, and volatile growth, that's probably going to increase and lead to more volatile inflation. And it probably is going to come up again, maybe not get as high as it did this time, but it'll be a recurring theme, we think, over the next 5-10 years. And, that has implications on portfolios because, inflation is a tax on a pool of assets. Like, it's just as bad as tax. It actually reduces the spending power. So it's very important, actually, from a portfolio perspective, to do what you can to keep up with inflation at the very least, or have offset that sort of tax on your wealth in real terms. And one of the aspects that does this really well is real assets. We think real assets, and that's everything from real estate to gold, commodities, and the like. This has a strong relationship with inflation, and we think that's something people should be considering is, how do I build a bit more inflation protection into portfolios going forward? But with that, since it was almost financial planning that I was talking about, worrying about your financial plan and the impact of inflation on your longer term goals and financial plans, let's hand it over to, we're going to hand it back to the host.
Yeah, I'll take it. Thank you so much.
All right.
I just want to remind everyone, if they do have questions, that they can drop them down in the Q&A box at the bottom of their screen. We'd love to give Greg an opportunity to answer some of these questions. Next on the docket is Oliver Yoon. I'd love to introduce Oliver. He's a founding member of the Harness team with more than 10 years of experience in the financial services industry in Canada. Oliver works alongside our portfolio managers in developing model portfolios, which are the building blocks, of course, for the investment portfolios for clients of Harness. He has progressive roles in the areas of portfolio management, relationship management, operations, mutual fund sales, corporate strategy, execution at the number of major Canadian financial institutions as well. He's currently the managing director and head of business management and strategy at Purpose Advisor Solutions. So I'd love to introduce and give the stage to Oliver.
Great. Thanks for that, Louis, and great to be here with all of you. I always love hearing Craig speak, and always kind of don't like going after Craig, because I think Craig obviously offers a ton of insights. I think his team does a wonderful job, interpreting everything that happens in the markets and how does that affect the investments, and ultimately make the right decisions for the investors and advisors that have entrusted him and his team to guide where the money goes and how to grow it in a safe and risk adjusted, maximize the risk adjusted returns. I think when we think about most of us, and for most of the clients that we deal with, I think it comes back to, how does all the things that Craig just talked about make sense for me? How does it make sense for my family? How does it affect my retirement plans? And I think that's the role that financial planning plays into the conversation, and in the context of how we think about making our money go further. So I think where I wanted to start today in our conversation was really around why does financial planning matter, And a couple of things that we've outlined here, I think most of you will agree, saving money is hard, and I think especially in the context of rising inflation and interest rates and things of that nature, I think it's all the more important to make sure your assets work harder. They also work smarter for you, and we'll go into a couple of examples on where I think it might be suitable for business owners to think about. Different ways that we think about reducing or deferring your taxes when you can and where you can. I think that's kind of the crux of what financial planning is and where financial planners, create their values. And certainly, we can go into that in a little bit more detail. I think the other thing that, a lot of Canadians, are challenged with is really understanding how much money do I need for retirement? When can I retire? How do the things that come up in my life affect my retirement? Whether, does that mean I have to work 2 years longer, or does that mean I have to work 10 years longer? And, the more financial planning advice that you can seek and good ones that you can get, I think allows you to plan ahead. It creates clarity in your financial future and just reduces some of that, anxiety or things that keep everyone up at night. And certainly, having a financial plan in place will allow you to get focused on building towards that, and staying focused of all the things that the markets do to us, right? I mean, we can turn on BNN or the news, and you hear the red headlines about markets dropping and whatever else. I think it creates a lot of anxiousness amongst our clients, and that's the work that the Harness team does with our network of advisors, which is really marrying together really good financial planning with really good investment management that Craig and team does over there, and saying, how do we put it together for you and your family, and provide clarity in your financial life? I think the third point here is around, I think more times than not, life doesn't work out exactly the way we plan or hope for. And so how do you be prepared for those situations, and how do you be prepared for the unexpected and protect your loved ones, whether that's through insurance, whether that's through having a will ready, whether that's through disability insurance, life insurance, you name it. But I think certainly, the role of a financial planner is to make sure that we go through our checklist of things that we want to make sure clients have to make sure they can stay ready for the unexpected, and not leave their family in a tough situation, when those things do arrive. And so, I think the last point here really is around, I think the cost of not doing financial planning or getting it wrong is really high. I think most of us pay for insurance because the cost of our lives ending early is significant, right? And it's significant for our families and others, and that's why people will pay the premiums. I think in a similar way, the fact that financial planning does create a tremendous amount of value in different ways leading up to retirement, that they can't be forgotten here. Right. So I wanted to kind of walk through two examples, and two things for you to think about, as business owners. One is really, understanding that there's an opportunity to use your business to grow your investment portfolio faster with deferred tax payments. And so what I mean by that, and the opportunity that, a lot of business owners have is, in Canada, obviously as a small business owner, you pay a lower corporate tax rate of 9 to 12% on active business income up to about $500,000, and that's done through the small business deduction. What the CRA allows you to do is you can earn up to $50,000 a year in passive income, so income that you've generated through investments, for example, without impacting your small business tax deduction. And obviously, corporate tax rates are much lower than personal tax rates, and that's really the example that I wanted to walk you through today. And so, take Jim, for example, he's generated $200,000 in net income after tax, after the corporate tax, and wants to put it into an investment portfolio for retirement. And, retirement's not for another 20 years. Option one is, he can set up an investment account inside of his corporation and have the $200,000 ready to invest. And that's a lot of the work that we do here with our clients. The alternative option is to actually withdraw the $200,000 either as a dividend or a salary, have it held outside of the business into your personal name, in which case, you've got to pay the personal tax, and you're left with about $133,000 to invest right off the bat. So if you look at the simplified illustration on the left-hand side there, we're going through kind of option one, which is that 200K held inside the business, versus option two, which is being held outside of the business. And obviously, right off the bat, if you look at the investable amount, the $200,000 and the $133,000 is a pretty stark difference as a starting point. Now, if we assume a 9% return over the lifespan of our example, which Craig and team have done better than that in some of the mandates. So take 9% for example. The effects of that difference multiply as the years go by, right? So after 5 years, the difference between option one and option two is somewhere like $100,000, and by the time it's 20 years, that multiplier effect and the compounding rate of return effectively grows into about a $400,000 difference. And obviously, one might make the argument to say, if it's held inside the business, you eventually have to take it out into your personal name and other things, which is absolutely true. And so even when we factor that in and say there's a higher tax rate to be paid in option one at retirement, or inside once you're retired, after factoring that in, you're still very much ahead in option one as you are in option two. And so option one, the assumption here is that you'll have a portfolio after taxes in your personal name of about $936,000. And in option two, you'll have a portfolio worth $666,000. And so the difference there really is more than $250,000. And that's a 40% difference between the two examples. So, the key takeaways is, don't forget that there's an opportunity to hold investments inside of your corporation, which can be very advantageous from a tax perspective. And obviously, when you're thinking about how you structure that, consult a tax specialist or your accountant, which I know we have on the call today. And certainly, when you think about the different types of investments to hold in your corporation, having growth stocks that that grow with unrealized capital gains is a bit more advantageous than some of the other asset classes, and that way it allows you to kind of defer the taxes to the furthest time away from today. Example two, another kind of quick and simple example, certainly one that I've used with a lot of clients this year as we look at kind of the interest rates that are rising for deposits. So I'm sure, going to your business bank account provider or other different deposit institutes, the interest that they'll pay on your cash deposits or your cash reserves, it has risen over the last year or two. Certainly, one thing that a lot of business owners sometimes overlook is, if you're keeping an excess cash balance in your corporation, one thing you can do is take that excess cash, set up an investment account, and invest it into what we call a high interest savings ETF that can earn you north of 5.3% in return. I'd say most banks, when I looked across the different interest rates, they're paying somewhere between 3.25% or 3.5%, and so that's a 2% yield that you can get incrementally by having your excess cash parked inside an investment account to holding a high interest savings ETF. And 2% might not sound like a lot, but in the context of a $200,000 cash balance that we're talking about, that's $4,100 a year. And $4,100 a year, and with $4,100 a year, you could pay for some really good financial advice. And I think there's merit to that advice beyond just the immediate kind of the tax savings opportunities that a good financial planner will identify for you. But beyond that, you can have confidence about how it impacts your total retirement plans, depending on the different things that you see in the markets. So the key takeaway, I think here is, make your money work harder. If you have excess cash in your business, maximize the return on it. Even though 1 or 2% might not sound like a lot, if you think about it on a per year basis, it does add up. And certainly, I think the benefit of that is, you can use that money towards paying for your ongoing advice. Great. So I think before I pass it over to Anthony, I think we've obviously, as a purpose, as a company, we've got lots of different resources that and insights that we can make available to you. Craig and his team write an excellent market ethos weekly. We provide also on an ongoing basis regular portfolio strategy, thought research around that. And in the business that I work, certainly, if you are seeking for a partner to have financial planning access to or investment management done with, certainly we're available to have a conversation about that.
Awesome. Thank you, Oliver. Again, before I introduce Anthony, guys, just a quick reminder: if there are any questions, don't hesitate to put them in the Q&A box at the bottom of the screen. We'll get to them. Oliver will get to them as once the presentation is completed with. So Anthony, who will be discussing tax planning, just giving a little background on Anthony Delfio, an experienced finance executive with demonstrated history of working in a variety of industries on turnaround, transformation, growth, and business development. Anthony has over 10 years of experience managing and advising Canadian and US companies on turnaround, transformation, and growth, and has had a specific experience spanning across a diverse industry base. His firm, Maple View Partners, specializes in strategic planning, operations, and performance improvement experience, and he's able to bring his CPA background to help his clients with audits, planning, and tax advising and reporting. So Anthony, I'll give you the floor.
Thanks, Luis. Yeah, so I mean, I think those last couple examples that Oliver provided were, those are powerful, and they're a good segue into what I'm going to be speaking about, which is, okay, so I work with a lot of small businesses, entrepreneurs that start businesses or growing businesses and ultimately want to sell them. It makes so much sense to do that within a corporation here. There's so many advantages here, but then kind of it's like, then it's what's next? What do you do with that? What's your strategy? And kind of how do you pick apart those some of the different tax strategies and business strategies as you kind of move through the life cycle of the business? And I'll give some examples that I've seen with different clients and things that are pretty common, but just I want to kind of help think through where I've seen where you can do a lot within the tax structure and in the business structure in Canada. So if you want to move to flip to the next slide. Yeah, so I'm kind of, this is just the summary, but I'm going to kind of walk through each stage here and kind of key tax strategies and pitfalls and things that I've seen as we go forward. Again, we've kind of talked about how to structure the business, but it's also equally as important right now is kind of what's the capital structure? Where are you going to find capital? Is it debt? Is it equity? And are there things that you can do that are non-dilutive, to improve that even more? And then as we go through the kind of the growth stage of the business and you grow your business, there's, it gets more and more important to know where you're headed, but also, to have the right accountant and the right financial reporting in place so that you can track your business, you can see how you're doing. Ultimately, when you do well and you succeed and you have a great business that you may want to sell, you need to be able to show those numbers to somebody that is a potential buyer, and you've got to be able to show what you've done. So that's kind of you want to really, there are some cost-effective ways to do that early on. A lot of people leave the accounting to last. You're an entrepreneur, you're kind of running your business, you're doing everything, you're wearing a lot of hats, but I'd encourage you to kind of think through, you put the right reporting and accounting in place early, and as you're going forward, you can track the growth of your business well, so that you can get to that end goal. So we want to flip to the next slide. Yeah, so I mean, I guess a couple of key points in the early stage and at launch. Depending on the business, you might be, you might end up, and again, you might end up losing money early on. You may end up saying, you might end up kind of intending even to take losses early on because you're building a product, you're building a business, and you're not going to make profits from day one, right? Things that I see a lot is, you know, there are R&D tax credits in Canada. It's called SR&ED. Not everybody knows about it. A lot of people do. So SR&ED. But if you're if you're building a product and you're putting a lot of money into that, if you meet the criteria of the program, you know, the government kind of helps to fund that. And that's through kind of tax refunds, right? So it's the type of thing that a lot of people know. And I've had clients that I bring this to them and they say, yeah, that's something we know about. It doesn't apply. Well, timing, the time and the circumstances might have been different when they found that out. You know, you got to really relook at these things, because oftentimes I found that it does apply and it does work for companies that and entrepreneurs that maybe think that it didn't work, right? So, you know, something to consider when you're growing your business. Now, on the capital structure side, you know, you really got to kind of think through, is it debt? Is it equity? Is it some combination? You know, obviously with high interest rates right now, debt may not make sense, but don't forget you know, that said, there is a tax deduction for interest, right? So, you know, you're going to be able to at least kind of have a business expense on the debt side that you're not going to have on the equity side. You also have to think through kind of what you're trying to finance, and, you know, basically kind of how the banks lend. You know, the banks in Canada are very conservative and they act a certain way, but they're good at financing certain things, if that's what you're interested in. I mean, if you have a great acquisition that you want to look at for your business, you know, the bank, you know, you can find a bank that can finance that, right? And so don't be afraid to kind of think big when you're growing your business and say, all right, well, you know, if I can leverage some bank money to grow my business even further, you know, it's out there, and there's financial advisors that can help you with that. And even little things like, you know, okay, so this is, you know, the other thing I think is, you know, set up even when it's early stage, think through kind of setting up an efficient administrative structure. So your accounting and your finance, set it up in a way that's efficient and it makes sense, right? You know, even little things like when you incorporate, you're going to have an HST account. Well, do your returns, you know, have your returns set to be filed annually, so you don't have to do these things every month. It's just going to cost you more for an accountant to file these things all the time. It's a little kind of simple thing, but, you know, people miss it sometimes. But really kind of think through how to set things up efficiently. And then, you know, kind of same on the employee side of things. You know, you can ultimately decide, you know, to kind of hire employees or subcontractors. There's tax implications, you know, CPP, EI, EHT for employees, but, you know, and then there's HST that you're going to be paying on subcontractors. So you can move to the next slide. Yeah. So, and then kind of as you're growing your business, kind of moving away from some of the tax issues, but just more, you know, how to make sure you avoid pitfalls, you know, really kind of know your cash flow as an entrepreneur. You know, you want to get this thing to a certain place. You know, you got to be the one, or you need somebody to help you with this to make sure that you know where you're generating cash, you know where you're spending it, you know what your burn rate is. Hopefully you're minimizing that and you're reducing that over time. But that's kind of the lifeblood of your company often is your cash, right? And so just make sure that you want to make sure that you have a good handle on that, whether that's through an advisor or, you know, as an entrepreneur yourself. And then, you know, if you did take losses earlier in the business cycle, you know, don't forget you've got those losses can count later on, right? So as you're making money later on, you know, you can offset those against future profits, right? And that lasts for a while to be able to carry forward your losses. So, you know, if you did invest into the business and you want to, and you're then going to grow it later on, like, don't forget that's value to your business as you go forward, right? And so once you start to kind of make those profits and you're taking money out, This is where you also kind of want to make sure you work with your advisor and understand the implications, right? So if you take money out of your corp, on day one, let's say, you've got to, like, at the end of the next fiscal year, you have to either kind of pay some taxes on that, or you have to pay it back, right? And so it's not kind of instantaneous, like you got to pay taxes right away. There is a window that you can play with there, but know kind of what those rules are, so that as you are taking profits out, you want to take it out in the most advantageous way, whether that be dividends, salaries. And it really kind of depends on where your income is and where and so I'd also say it's best to kind of have your accountant run scenarios. Do the analysis for yourself, because there's no one right answer, and it really depends on where you're at in the business. So let's move on to the next slide. So as I mentioned earlier, I mean, I really do kind of think it's critical to understand kind of how you're getting your accounting and your tax advice. There's lots of accountants out there and tax advisors, but they do different things as you kind of move through the cycle of your business. So early on, when you only need a tax return and an annual set of financials, that's kind of all you're getting from your accountant, and that's great. That's kind of maybe all that you need, but kind of looking at numbers once a year it's not gonna really help you manage the business. And so you've got to find some way to force yourself almost to be able to look at the business more frequently at kind of a frequency that makes sense. It's often monthly or quarterly, but you really want to be able to look at the business more regularly so that you can manage how you're doing, right? And maybe you have a budget, maybe you don't. But budget is a great thing because it forces you to track to what you think is going to happen. But more often than not, I really stress that you want to make sure that your planning and how you think about how you're growing the business and how you're driving growth, and those levers, those need to match your financial statements and your financial reporting that you get from your accountant. Because I see this all the time, that the accountant kind of goes off into their world and they kind of do their thing. They don't do it for the business owner often. They do it in the easiest way. They do it in the way that's easy for them. You want to force them to kind of make sure that reporting makes sense to you. It matches how you're thinking about your business and how you want to grow it. I often will have to come in, and frankly, and fix all that later on, because as kind of an operational CFO, I come in and I'm trying to bridge the gap between the accountants and the entrepreneur, and those two things need to tie. Like, how did the business do, and what are you trying to do in the future, and how you're trying to grow the business. So that's kind of like just the key message that really probably needs to start early on in the life cycle of your business, but it's never too late. You want to make sure that those things align and that you're looking at the performance. So then hopefully you have that mindset in place. But when you've gotten to the point that you've grown a business and it's done well, and you're thinking about a sale, you really need to make sure you've had that reporting in place from a while. Like, you want to be able to show the trend. It's important to know, this isn't even something that's in a set of financial statements from an accountant, but you need to be able to know what your EBITDA is, because that's typically, if you're selling a private business, that's what most buyers care about, is what's the ability to generate future cash flow. And so that's something that is calculated in an EBITDA or a normalized EBITDA, to kind of normalize, meaning that you're kind of normalizing for things that non-recurring things, or things that kind of wouldn't have an impact to the future of the business. There's future cash flow. There's any asset value that's in the business, and like I mentioned before, there could potentially be some loss carry forwards, which is subject to some CRA rules. So, that can be a little trickier, but you really want to be able to understand kind of where the value of the business is. And then, in Canada, there's there's the lifetime capital gains exemption. So, up to the, north of 900,000 in 2022, if you sell the shares in your business, you're exempt from having to pay taxes on those profits. So again, while kind of overall the corporation and the corporate structure, is powerful in Canada, there's even more there really if you plan it appropriately. But again, this is where even, having investments, too many investments that are not operating in your business, you can get dinged for. So you also kind of need to, not on day one, but at some point think about kind of having a holding company structure in place so that you meet the criteria for the lifetime capital gains exemption. So that's kind of from start to finish. A lot of kind of some of the key things that I see as I'm advising clients. And, more than happy to have a conversation with any of you and free of charge and to try to help you with your business. I'm passionate about helping kind of small business owners in Canada, grow their businesses and make smart decisions.
Thank you. Thank you so much, Anthony. I do see a question for Oliver. Oliver, if you wouldn't mind. It's a question from MB. Question for Oliver. Thinking about financial planning is one thing, getting started is another. What's the best way to take the first step?
My email address is right there. Give your contact information. I'm happy to do kind of a quick discovery call with you and understanding what you're looking for and where your financial situation is. And certainly can work with you to get a financial plan in place. And, I think one thing that I've seen over and over again is good financial planning advice pays for itself. Just in terms of, opportunities that you didn't know about that they can help you find. And so, I'd encourage you to pick up the phone or write an email right away. And I think taking action against it is the biggest thing. And, I think when I come across different financial planners, the biggest shame in this industry is when they work on a really good financial plan for a client and the client then doesn't take action against it. And so that's where the harness business is really focused in, which is how do we make sure there's an urgency for clients to understand the financial plan, the tax savings opportunities, and then take action against it. And that's where harness can step in.
Well, thank you, Oliver. Another question. This time it's for Anthony. When should I talk to an accountant? Before I start? Too soon?
I mean, good question. I'd say it's never too early. Because I'll have conversations with with people that are thinking about it, and there's pitfalls and there's things you want to think about even before you set up the corporation. So it's never too early. There may not be more than just a quick conversation, but it's never too early. One story I've seen recently, and this is on the doctor side of things. So a lot of doctors would typically set up a medical professional corp, and I met with somebody who got bad advice on that and waited way too long and got a massive tax bill. So, better to have a cup of coffee early than to risk something like that.
My apologies. Before I said the question was from MB, I think its question is actually Mark Baroni, who's typing in the questions on behalf. So my first time hosting a webinar, so my apologies if I hope I didn't offend anyone. I got a question for Craig here. What's the best time to get into the market?
Well, that's kind of a bit of a philosophical question. It's probably better today than a week ago, if that helps anybody in their decision-making process. But no, I go back to the financial planning side. Like obviously we have our views on the markets. We're probably a little bit more bearish right now, a little bit more cautious. So I think if people are putting new money to work, having a legged-in approach certainly is probably a better approach than jumping all in. And that's probably a better approach than just sitting on the sidelines and waiting as well, because very often you end up sitting on the sidelines and 2 years down the road, markets make new highs and you're sitting there going, oh, it never did get cheap enough. Because, that's one of the problems with investing in emotions is, the fact is usually the best times to buy are when all the news is negative, and the best time to sell is the opposite. So I think it becomes challenging, but that's where having sort of a disciplined financial plan certainly helps sort of get people on their path and keep them on their path, because it is the power of compounding that like gets us to happy, healthy, hopefully wealthy retirements. And that eighth wonder of the world works because of time. So I think people should be in the market, but I think from a short-term perspective, we're certainly a little bit more cautious and would recommend legging in. How is that for a completely neutral answer that nobody could?
Yeah, there's a saying that goes, it's not about timing the markets, it's about time in the markets. And so
Oliver, I believe that saying was created by the marketing departments of asset management companies. So I'm not sure if we want to marry ourselves to that one. Even if we are an asset management company.
Yeah, dollar cost averaging in when you think it's when you're getting nervous is the no lose answer, I would say. Yes.
It's a happy medium.
Yes.
Guys, I really, as my first time hosting a webinar, I really do appreciate the human touch that you guys brought to the webinar. Very approachable, easy to ask questions, easy to follow. So thank you very much, Craig, Oliver, and Anthony, for volunteering your time, and thank you to everyone for who joined and volunteering your time as well. I hope we all gained something from the experience, and we'll hopefully see you again sometime soon during the next webinar. I do want to ask if anybody will leave up the contact information for a little bit longer. So if you guys want to take a screenshot of Craig's, Oliver, and Anthony's private info, contact info, you guys can reach them as they all offered to you before. So if there's no other questions, I think we're ready to wrap it up. And until next time, thank you, guys.
Thanks, everyone.
Thank you.
Thanks.